Trading in a K-shaped market. A K-shaped market refers to an economic or market recovery in which some sectors, companies, or groups recover and accelerate upward while others stagnate or decline, creating a visual pattern that resembles the letter K when plotted over time. Unlike a V-shaped bounce where the economy or market quickly reverses direction for the majority, or a U-shaped recovery which is broad but slow, the K-shape describes divergence. Winners and losers pulling away from each other. This divergence is not only an academic label but a practical reality traders can observe in sector performance, market breadth, employment trends, and consumer behavior. Understanding a K-shaped market helps traders see where growth concentrates and where risk accumulates. A K-shaped market is distinguished by divergence. Some sectors and companies rebound and grow quickly while others decline or stagnate, unlike a V or U recovery which is broadly shared. The K metaphor emphasizes the simultaneous upward and downward pathways within the same economy or market. The drivers are often structural as well as cyclical. Some industries benefit disproportionately from secular trends like digital transformation, remote work, or shifts in consumer preferences, while others suffer from structural weakness or temporary shocks that alter long-term demand. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmenttees.com and use code BLOG to receive 25% off your next purchase. Fiscal and monetary policy can accentuate divergence by providing liquidity and stimulus that disproportionately helps well-capitalized firms or households with greater access to credit. Corporate balance sheets, supply chain resilience, and the ability to adapt to changing conditions determine whether a company rides the upward arm of the K or slides down the downward arm. For traders, these fundamentals create predictable patterns and opportunities for relative performance trades, momentum plays, and risk-managed long-short strategies. Data and indicators help identify K-shaped dynamics. Earnings dispersion, the difference between top and bottom quartile sector performance, market breadth indicators, and divergence between headline GDP and employment for different income brackets are all signals. Traders can monitor earnings per share revisions, upgrades versus downgrades, and relative strength indices for sector ETFs. Increasing concentration in market cap contribution, where a handful of mega-cap firms do most of the market's lifting, is a hallmark of K-shaped markets and a sentiment signal that divergence is widening. Recognizing these signals early allows traders to allocate capital toward the upward arm before the consensus fully prices it in. K-shaped divergence can last months to years, but the fastest and most profitable moves often happen during the early phase when market narrative shifts and institutional flows start to reprice assets. Traders who can act decisively when change is nascent gain the most asymmetric returns. But patience is also rewarded. Structural shifts will play out over long windows, and traders who treat K-shaped divergence as an investment thesis rather than a short-term trade will be better positioned to harvest gains. A practical way to implement trading ideas is through sector rotation, pairs trading, and disciplined position sizing. Sector rotation means shifting capital into sectors showing accelerating earnings revisions, improving technicals, and supportive macro tailwinds. Pairs trading involves identifying a long candidate and a short candidate within the same sector or between two correlated sectors and sizing them to be market neutral. This allows traders to isolate idiosyncratic outperformance and reduce exposure to broad market risk. Risk management is essential because divergence can be sudden and reversal risks are real. Stop-loss rules, volatility-adjusted sizing, and diversification of idea generation reduce the chance that a position that should represent a structural trend is instead a temporary mispricing. Profiting requires both the macro view of divergence and micro-level selection. First, traders should identify the sectors and business models that are on the rising arm of the K technology, software as a service, e-commerce, certain healthcare segments, and companies that reduce labor or physical contact often pop up as winners during disruptive periods. Second, traders should look for the downward sectors that face lasting demand destruction, margin pressure, or structural decline. Retailers with poor e-commerce presence, travel and leisure companies heavily reliant on physical presence, and commodity-sensitive firms are typical laggards in many K-shaped recoveries. By pairing longs in the winners with shorts or underweights in the losers, traders can create a performance spread that benefits from relative divergence regardless of whether the overall market rises, falls, or grinds sideways. K-shaped trading examples. Imagine an economic shock that accelerates online shopping adoption. E-commerce platforms and logistics firms benefit from higher demand in scale economies. Their revenues grow and margins improve, so their stock prices rise sharply. At the same time, mall-centric brick-and-mortar retailers face weakened foot traffic, higher vacancy rates, and squeezed profits, which drag their valuations down. A trader who recognizes this pattern early could buy shares of a leading e-commerce company while shorting a struggling mall retailer, profiting as the two paths diverge. Another example comes from workplace technology. If remote work adoption accelerates, cloud providers, collaboration software firms, and cybersecurity vendors may experience growth, whereas certain commercial real estate REITs could see rents and occupancy decline. A long position in a cloud infrastructure ETF paired with a short position in a commercial REIT could capture this K-shaped separation. Beyond sector and pairs trades, option strategies can be powerful in a K-shaped market. Buying concentrated directional options on rising stocks allows traders to leverage asymmetric upside while controlling downside. Writing covered calls on winners can generate income while still benefiting from appreciation, though it caps upside. Put spreads or protective puts on laggards can be used where downside acceleration is a concern and outright shorts are risky. Investors with longer-term capital can tilt portfolios through factor exposures, overweight quality and growth where those styles outperform, and underweight highly cyclical value names that struggle during structural shifts. The key is to match strategy duration and instrument choice to the expected horizon of the divergence. K-shaped markets bring unique risks. One major risk is overstretched leadership. If winners become too popular, valuations can detach from fundamentals and become vulnerable to a broad risk-off event. Another risk is policy normalization. If fiscal or monetary support is withdrawn, lagging sectors may not rebound quickly, but winners could also lose momentum if liquidity-driven demand falls. Cross-correlation shifts can quickly change expected payoffs. Industries that appeared isolated might become correlated again under stress, causing pairs trades to misfire. Traders must therefore keep position sizes modest relative to portfolio risk, perform scenario analysis, and maintain liquidity to adjust positions quickly. For traders who prefer mechanical approaches, trend following across sectors and momentum screens focused on relative strength often perform well in K-shaped markets. Algorithms that detect widening performance gaps and trigger reallocation rules can exploit divergence without subjective bias. Yet mechanical strategies should be complemented by discretionary risk overlays because exceptional events and policy shifts require human judgment. Combining quantitative filters with qualitative checks such as management quality, supply chain resilience, and consumer behavior shifts improves the chance that a trade captures true structural divergence rather than a fleeting rotation. Conclusion. A K-shaped market is a practical lens for traders because it highlights where economic activity and investor capital concentrate and where latent risks remain. Profit opportunities arise through careful sector selection, relative value trades, and disciplined risk management. Traders succeed by combining data-driven signals with business model analysis and by choosing instruments and timeframes that match their conviction. A K-shaped market rewards those who can see divergence early and manage the asymmetric risks that come with concentrated leadership. Thank you for watching.